Right. Good day and welcome to international trade. So this is our first class on international trade. So we'll pretty much be talking about the basics of international trade, just the starting parts of the module. So that's what we are going to be doing today. So I'm going to share some. I'm going to share the screen here, and the screen has some notes. Okay. I'm hoping these are the notes. Yes. So these are the notes that were shared in the group. So, and by the way, I didn't prepare these notes. So these notes were prepared by somebody else. I think I'll definitely prepare my own notes on this, but these are nonetheless good notes. I'm not complaining. I'm actually also happy with the notes, but we will do our own notes. All right. So the beginning point there is the important definitions. The definitions that the terms that will come across throughout this module. So capital intensity is defined right there. So this we're going to be dealing with probably in 2 weeks' time. Capital intensity, capital abundance, with much got to do with what we're going to be discussing today. And then a tariff and a quota. These are relatively not new terms, and we are going to discuss them much later in the module. Strategic trade policy as well much later. Mercantilism, this we're going to talk about today. A zero-sum game, absolute advantage, comparative advantage, all this we're going to deal with today. And then probably next week or in 2 weeks' time, we will be talking about the product possibility curve. Hopefully next week, yeah. The product possibility curve, and then the terms of trade we are going to talk about today as well. So on study unit 1, there's just a basic introduction into international trade. So international trade is generally an extension of what we already know as domestic trade. So domestic trade, when you go out there and you purchase something, it constitutes domestic trade. So by definition, domestic trade is trade within the borders of a country. We refer to that as domestic trade. When you go to, say, Checkers, you buy some meat, you are trading, right? There is an exchange there. With you give them money and they give you a product or a commodity. Sometimes you could be paying for a service, right? That is still trade. But what we're particularly dealing with here is international trade. So when such an exchange goes beyond borders, we begin to refer that as international trade, right? So international trade focuses on the flows of goods and services, labor, direct foreign investments between countries, right? So sometimes you could be purchasing goods, sometimes you could be purchasing services, whatever the case is. But that generally constitutes international trade. All right. And then a major difference between domestic trade and international trade is the aspect of the currency that is used. So if it's going to be domestic trade, in our case, we're going to be trading in the South African rand, right? But when you start engaging in international trade, then if you're going to be buying something, say from Botswana, then you might need to use their currency, right? You might need to use their currency. So which means there is, in as much as there is an exchange of goods and services, the currency that is being used now might have to differ, right? You might have to change your currency to another currency, right? But most of that is covered in international finance and with the system module, the one that we are doing today, right? And then, of course, another important difference is that governments can impose a wide range of commercial policies on imports and exports of goods and services. But at the end of the day, the government can as well do the same with domestic trade, right? There can be certain restrictions on some products. They can be, I mean, we've done that before where you have a government from a government controlling the consumption of certain goods and services, having policies that control the consumption of certain goods and services. So it's similar to the restrictions that a government can put up on trade, on international trade, basically. It's very similar, but the difference now is here. That's when we start talking of import quotas, maybe. We can even talk of some tariffs, etc. But we're going to discuss that towards the end of the module. But that's pretty much what you find here on international trade. All right. And then, of course, another difference is that the factors of production, such as labor and capital, are more mobile domestically than they are internationally. So when we look at these things at an international terrain, there are a lot of other international laws that come into play, right? You can't just move to Lesotho and start working tomorrow, right? There are a lot of restrictions that that you come across along the way. You need work permits and what have you. Traveling is not easy, you know. You need to work out your accommodation, so it's not so easy, right? So hence we say it's actually more mobile domestically. Right? It's easier for you to move, say, from one province to another here in South Africa than it is for you to move from here to a country that another country even within the SADC region. It's not so easy, right? You need to cross borders. You need to have a passport for starters, and then again you need to get yourself a work permit for that place. So it's not so mobile. All right. Then these, of course, you don't really get much. You don't really get examined on these, but it's just worth discussing because it's part of international trade. It actually makes a very good introduction to international trade, so that it brings the whole module into perspective. Right. Challenges of globalization. Labor migration leads to more efficient utilization of labor, but also leads to job losses. So this one we are very much aware of, particularly when you talk of semi-skilled labor. It obviously gets harmed by a nation's immigration policy. So if the policy is very lax, I think most countries are actually facing such a problem. If you look at countries that are in Europe, countries in Europe, they are complaining a lot about migrant workers as a result of this thing that we're talking about, that there are job losses, because once there's an influx of workforce into a country, drives the wages down, you see. So employers don't see a reason why they should pay you high when they can hire somebody else that can do the same thing that you are doing at a cheaper rate. So now what happens is, once there's globalization, so with globalization, we're basically talking about the world being reduced to a global village. In other words, where now it becomes easy for you to travel into other countries and to work into other countries. It's easier for us to exchange, whatever we are exchanging, services, goods, money, and what have you. It's a result of globalization, where we are being reduced to one community. If you look at what happened after post-corona, I think globalization has been a lot faster, especially if we were to look at it from the time when internet came into play. I mean, I was alive before the internet was rife the way it is here. We're not so connected with everyone else around the world, but as soon as the internet was introduced, we really became a global village. You can communicate with anyone around the world. You can trade with anyone around the world. So that's an example of the impact of globalization in our everyday lives, right? So at the end of the day, globalization, of course, it brings with it advantages, but it comes at a cost, right? On the other side, like every other thing that we come across in life, there's a good side to it and there's a flip side to it. So the good side, of course, there's efficient utilization of labor. So you are not just limited now to accessing a workforce that's only here. I mean, if you look here in Africa, particularly, we have most of our teachers, most of our good English teachers are teaching Chinese people English online. So this is an example of the impact of globalization in education. So you don't have to teach English in China, but you can teach English in South Africa to Chinese kids, to people who are in China. So that's what the internet can do for you. But now think about this: if you're going to be teaching kids in China at a cheaper rate than a Chinese teacher who's located in China, then it basically means you have taken a job from them, right? Basically means you have taken a job for them. So that's part of trade, by the way, because the Chinese are purchasing a service from you, right? They are purchasing a service from you, and you are abroad. So you are selling the service, but you are here in South Africa selling it to somebody who's in China, and ideally they are going to be paying you in their currency. I think the ones that normally do that get paid a fee that's in US dollars, but when it lands here, obviously it needs to be converted to rands, but it's quoted in US dollars. So that's just another example of trade. Then financial globalization leads to more efficient use of capital throughout the world, of course, and provide higher returns for individuals and corporations, but also leads to a period of international financial crisis. Okay, what we are talking about here is financial globalization gives you access to foreign markets. So in other words, you can invest in the New York Stock Exchange. Even when you are here, you can do that in the London Stock Exchange. Basically, you can invest. There is no limit, right? That's financial globalization. Anybody in any country can invest in JSE because we have become a global village, right? That has become increasingly possible now with the increase of our internet access, etc., etc. But what's the problem with that? The problem is once there is a collapse, say in the London Stock Exchange, that's going to have a ripple effect on many economies because now we are connected, right? We are connected. So in other words, if you have a company that's here in South Africa that invested in the London Stock Exchange, it's going to be affected by a collapse there. So once that company is affected there, we might start seeing job losses here at a local level as a result of something that is happening abroad. So I think if you are to trace back some of these financial crises that we've had in the past, like in 2007, I think the most recent one was in 2007. Most popular one was in 2007. Look at the ripple effect that it had on many of these economies, right? It even came down here to South Africa. We felt the effect here. So that's one challenge there with financial globalization. And then the other challenge is we're also running out of resources such as petroleum and other minerals. So I would say in theory, yes, this is true, obviously, because the demand for these products is definitely going to be going high, right? The demand for these products is going to be going high. So as a result of globalization, for instance, our consumption for vehicles has gone up, right? If you look at even the third world countries, their consumption for vehicles has really gone up. So what effect does that have on the petroleum deposits? So it's obviously going to have a certain effect on those petroleum deposits up there, either maybe in, it could be in Iran, or it could be in Nigeria, or even in where Colonel Muammar Gaddafi was, right? But at the end of the day, this is obviously up for debate, right? It's up for debate. The issue of natural resources, it's up for debate. All right, but at the end of the day, on the balance of it all, international trade and globalization has a very good effect in our lives, and we would obviously appreciate that. All right, and then Under international trade, if you bring South Africa into the context of international trade, here is a graph that's going to be showing South Africa. Okay, this one here basically talks about trade openness, right? South Africa's trade openness, and this is measured by adding your exports and your imports and dividing by the GDP in that particular year, right? So which means as a numerator, you have your exports and your imports, and then you divide that there by the GDP. So this we're most likely gonna come across in assignment 2, but most of this is just gonna be an analysis of what you see there on the graph, the trend, basically talking about the trend and some of the reasons that could have caused a decline. So a decline or an increase there. But in this instance, I think, or even in the instance of either an examination, but most likely on the assignment, on the second assignment, most of the information is going to be given on the scenario. So you'll be able to see that, for instance, here they talk about that decline in, okay, during the 1980s, yeah, they talk about the decline. I think we can see close to 1980 there, right through up until 1994, there was a decline there in trade, in trade openness, right? And then obviously the possible reason for that there is sanctions, right? So South Africa was under sanctions during that time, and as a result, so what effect these sanctions have? So apparently it didn't have a big enough it didn't have a big enough effect on the exports as a result of the kind of goods that constituted our exports. Were dealing mostly with base metals and the minerals. So they comprise the bulk of our exports, and we obviously the world couldn't do away with those ones. So we kept on exporting those, right? But the effect was felt on the imports. Like the effect was felt on the imports because during that time the government responded, right? The government responded by imposing restrictive measures, right? Particularly, it was a tight monetary policy just to curb the people's imports there. So hence you can see that decline. Hence you can see that decline there. All right, and then towards the end of that page there, we'll talk about the gravity model. So the gravity model basically seeks to explain why some countries trade with other countries, right? Which is also pretty much what we're going to be doing on the bulk of this module. Why some countries trade with other countries. So there's basically a formula for that. It's actually taken from physics, right? It's something that is taken from physics, but we use it here as well. But it basically entails that countries with big GDPs tend to trade with other countries that have got big GDPs. In other words, they gravitate towards countries that have big GDPs as well. And then the other one talks about the distance between the countries. So if the country is located far, then we expect that the trade is going to be much smaller than when a country is next door. So if you want to look at that in practice, if you look at our trade between South Africa's trade with a country like Zimbabwe, that's just here, right, which is just next to us. We expect that if we are to go with the gravity model, then we expect that our trade is going to be quite big, right? We'll go in big with Zimbabwe because they are very close to us, which actually makes a lot of sense, right? It should actually make a lot of sense. And then in that instance, if the GDP also of Zimbabwe was just as big, then it means this will definitely hold true. So if you look at that, speaking in terms of GDP, South Africa is trading, our biggest trading partner is China, and China has a very big GDP. So it makes a lot of sense, right? This model would actually make a lot of sense in that regard. But But when we talk in terms of distance now, then it doesn't seem to work because China is quite far. It's actually further than some of the countries that we have here. Right. So at the end of the day, we just talk about which one has a bigger influence, right? Which one has a bigger, say, gravitational pull, right? Either the distance or the size of the GDP. Right, but this is just for discussions anyway. It hasn't gone any bigger. I haven't seen any of that in an exam or in an assignment, but it's just important for us to know. All right, and then all right, the rest of this we can probably just read through, just to expand your knowledge there, just to bring those things into perspective. But what we're going to be going big on as far as examinations and assignments are concerned starts right here on chapter 2, right? So what are we doing here from chapter 2? We are basically trying to explain the patterns of trade, why one country is trading with another country, right? This is basically what we're going to be doing. Then we're going to do that by, first of all, examining 3 theories, right? Number 1 is going to be the theory of mercantilism, and then the second one is going to be of absolute advantage, and then the third one is going to be of relative advantage. So those are the first ones that we are going to look at. So at the end of the day, we should be able to run a brief description of what this is about, right? Just a brief explanation of what it's about and what it postulates, basically. So when we talk of mercantilism, we are looking at a period somewhere somewhere between 1772, because that was David Ricardo. We are looking at somewhere between 1711 and 1776. So this was a time when there were a lot of merchants, right? This was a time when we had a lot of merchants, and you must remember that most of these theories have, if you look at the background of these theories, they basically depend on who's paying who, if I'm to say, or if it's right to even talk about this in this module. It's about the wealthy people or the prevailing class at that time. So the writers were basically proponents of whatever prevailing class is there. So if you look at that time, the time period when you talk about mercantilism, we are looking at a situation where most of the rich people were merchants, right? Most of the rich people were merchants, and those were the people that were supporting the state. So in other words, it would make a lot of sense for you as an economist to write in favor of those things and to promote such things. You know that not everything that you write at the end of the day, if it's going to be published, if you look like if you're going to be a news reporter, for example, you must be a proponent of something. So at the end of the day, it's going to depend on who's paying you or who's in power during that time. So we must analyze these in such a context so that we can be able to understand better what they are talking about. So the basis of these mercantilists, they believe that trade is a zero-sum game. So what do we mean when we say it's a zero-sum game? We are basically saying both parties can't benefit at the same time. So when one party is winning, the other party has to lose. So at the end of the day, you always gain at the expense of the other party. So who were the people that were gaining in terms of this theory? Whoever is exporting, the seller is the one that's gaining at the expense of the one that's importing. So as a result of that, it was important for a nation to find itself exporting much more than it is importing, right? So this is what these writers advocated for. So that would basically mean that they would have to advocate for a heavy government involvement, right, in the affairs of the state. It means that the government has to create policies that promote trade the way that they want it to go. So in other words, the government has to promote exports and it will have to discourage imports, right? So this was back in the days, but we still do see that even today, right? We still do see that today. So in other words, we still do have a remnant of mercantilism even present, right? You find that governments are going to be encouraging. If you look at China, for example, China is very big on exports and very small on imports. I remember some years back, I was listening to a documentary again about India where they had a policy that you have to buy local, right? You have to buy local. You need to. So in other words, if you are buying local, you are discouraging imports, right? So the policy was that consume everything that is made in India. So they were discouraging imports, and then in a way promoting exports because we do have Indian products here, right? I mean, some tractors and some vehicles are even made in India. If you look at not so long ago, I think we had such a policy in the SAPC. I think the previous COO was also encouraging local consumption, right? So you wanted to give first preference to our local artists, right? And then the other one. So even music, you can export and import music, right? So that was the case with the previous COO. He was discouraging imports and promoting our local artists. So in other words, he was promoting our local consumption. So that basically shows that to some extent he also did believe in the theory of mercantilism, or these people still do believe in that theory. So once you see a government restricting imports, right, a government restricting imports and promoting exports, they are basically in favor of that. So whenever you are asked about the theory of mercantilism, one thing that you need to mention is how trade is a zero-sum game. According to the proponents of this, you only benefit when you export. And then the other thing which I haven't mentioned is that they did so because they believe that the wealth of a nation is basically based on the silver and gold that you are able to accumulate. So in other words, which is the money that you are able to accumulate. So in those days, trade was in terms of silver and gold, right? So at the end of the day, if you can export, then it means that the other country is losing silver and gold at your expense. So that's the second thing that you can mention on that there, right? And then the third thing that you can mention is the government's involvement there, right? To a very large extent, the government needs to be involved because the government will have to control the imports and then have policies that encourage exports. So in today's language, such policies would be tariffs, for example, putting in tariffs. And again, you can look at some incentives that the government gives to exporting entities, right? So that's still part of mercantilism there. Those are the remnants of mercantilism, things that we see in today's governments, in today's government policies, which emanated from this theory. All right, and then came Adam Smith. Adam Smith was the father of capitalism, basically advocated for free trade, right? Free trade is unrestricted trade. Basically, it's unrestricted trade where we are not going to be imposing on exports or imposing on imports. You just allow free trade. Why did he do so? He says that trade needs to be voluntary now, right? It needs to be voluntary. So if you read much about the one which we discussed earlier, the mercantilism, you will realize that that was the reason why countries were colonizing other countries. It was because of their drive, right? Their drive on the theory of mercantilism. They wanted to win at the expense of other countries. So, which meant that you will have to get raw materials very cheap at the expense of your colony, so that you are able to export things expensive and gain for your country. And it did work well for them. If you look at most of these first world countries, these are countries that were on the backs of poorer countries at the end of the day. So that did work for them. All right, but not what Adam Smith believed. So Adam Smith actually believed that trade needs to be voluntary. And then he said trade is not a zero-sum game. So in other words, in order for us to engage in trade in willing terms, we basically have to come to an agreement where we are both benefiting from such an engagement. If you look at domestic trade, for example, you wouldn't buy a product that you don't benefit from, right? You wouldn't buy a product that you don't benefit from. So which should be the same with international trade. The only reason why one party should engage in international trade is that that party must gain. So for trade to be voluntary, then both parties or both nations need to gain. But under what circumstances then do both nations gain? It's when one country, or it's when trade is based on absolute advantage. So what is absolute advantage? When we talk of absolute advantage, we are basically talking about a situation where one country is more efficient in the production of one product than the other country. And then the other country, say country A, is more efficient in the production of potatoes than country B, and then country B is more efficient in the production of cabbages than country A. So under those circumstances, then country A can specialize in the product that they are more efficient in producing, and then country B can also specialize in the product that they are more efficient in producing, and then they can trade with each other. All right. So those are the basis of that. That would be a beneficial basis of trade. So where you are doing what you are good at, and the other country is doing what it's good at, and then you can exchange your products. So of course, there are different sources of of absolute advantage. It can basically come from any one of the factors of production. But as you are gonna see here, some of the assumptions where this was built upon basically had got to do with labor, in terms of labor, the efficiency of labor. So most of what we'll be dealing with in terms of the theory of absolute advantage there by Adam Smith has got to do with labor, which also comes out to be a disadvantage if you check these notes again. I'm sure it's there, which also comes out to be a disadvantage of this theory in particular. But these are the assumptions. Producers and consumers display rational behaviors, and then we are normally dealing with this with two countries and two commodities. This is just to simplify, right, our discussion. And then those commodities need to be consumed in both countries. So this is just for the sake of theory, so we can try and explain why countries trade with each other. So I know there are some products that are consumed in other countries that are not consumed in other countries. So we're not dealing with those products here. And then we also assume that there is full employment. And then labor is the only factor of production that we are dealing with here. And then we also assume that there is perfect competition and there are no barriers of trade. So remember, Adam Smith was in any case advocating for free trade. All right. So Adam Smith theory serves the interest of factory owners who were able to pay lower wages because of cheaper food imports. So at the end of the day, this is what we are talking about. So these theories are basically to serve certain interests within the society. So you can't find yourself, I mean, the higher you go, you will realize that even as an economist, you might find yourself having to be writing articles in favor of a certain political party. For example, if you are going to be employed by the ANC today, you will have to be pushing a certain narrative, right? Writing articles that are in favor of the policies that the ANC wants to implement. But if you are employed by say the DA or the EFF, then you're going to be writing articles that are in favor of what they want there. So this is pretty much what I was referring to in the beginning, that these were basically written to serve certain interests of that time. So hence at the end of the day, you can't have one that is foolproof, one that is totally correct and the other that is totally wrong. So you can basically have a little bit of that mixed with a little bit of the other one, etc. So the illustration that's given there basically talks about absolute advantage, right? So you can see South Africa can produce 20 coffees while Namibia can produce 5 coffees. So it means South Africa is an absolute advantage in the production of coffee. and Namibia has an absolute disadvantage in production of coffee. Why? Because South Africa is more efficient. How do we see that? It's because they are producing more coffee than Namibia. So this is under the assumption that the labor is held constant. So in other words, if you're going to be looking at 5 employees there, in South Africa, those 5 employees can produce 20 coffees, while in Namibia, they are only producing 5. But when it comes to lemons, South Africa is not doing so good. They have an absolute disadvantage because they are producing only 10, while Namibia is at 20, right? With the same amount of labor that is put in, right? So if you look at the definitions earlier, there's one of the definitions of what we call autarky prices. So autarky prices are more like the domestic price, right? And then here we're not talking of the domestic price in terms of rands, right? In terms of monetary terms. You know, in monetary terms, the price can change as a result of, say, inflation, right? But we're looking at the real price. We are basically talking about the real price. Hence, we are looking at the price in terms of a product versus another product, or a product compared with another product. So that's the real price. So if you're going to look at the domestic price of right, the domestic price of lemons, for instance, if you're going to look at the domestic price of lemons in South Africa in terms of coffee, then 1 lemon is going to be equal to 2 coffees, right? But what about in Namibia? Then 1 lemon is going to be equal to 5/20, right? It's going to be equal to 5/20. So that should just about be a quarter, or 0.25. So we refer to that there as autarky prices. So when we talk of right here now, when we talk of where the range of price, right, the beneficial range of price. So for trade to take place between SA and Namibia, the international terms of trade must fall between 2 countries' domestic terms of trade. So which is 2C, so which is 2 coffees to 1 lemon to 0.25. So those are basically the autarky prices. So it must lie in between there. So in other words, if it's too expensive, then they should rather produce for themselves, right? If you're going to be selling, for example, if you're going to be offering coffees to South Africa at a price that's over 2, it basically means that it's cheaper for them to produce for themselves, right? So it must be within that range for both countries to benefit there. All right, and then next up is the situation now. The last one that we're going to deal with today is a situation where a country has got an absolute advantage, right? A country has got an absolute advantage in the production of both commodities. So remember, Adam Smith says, in order for trade to take place, one country has to be more efficient in the production of one product and less efficient in the production of another product. But how do we deal with situations where large countries like China can produce many things, right, a lot of products, better than a much smaller country? So in other words, this is a situation where the United States, on that illustration there, the United States can produce 6 of wheat bushels, while the UK can only produce 1. So it means the US has got an absolute advantage there if you're looking at 6:1. And then when it comes to clothing, again, the US seems to be producing a lot more than the UK, given the hours there. So remember, when we are talking of the hours there, we are referring to the labor hours, right? This is pretty much an extension of what Adam Smith started. Remember, we are basing this on labor, right? So if you're looking at those circumstances there, according to Adam Smith, trade was not possible there because the US is not going to gain anything from the UK because they can basically do all those products better. But David Ricardo actually came in the picture and said, no, it's not always the case. You have to look at a country that has got a comparative advantage in the production of one commodity. So they have to specialize in that commodity. So Most importantly, how do you find that now? We are basically comparing we are basically going to be comparing the absolute advantage and the absolute disadvantage there. So a country is supposed to engage in trade that is beneficial only if they specialize in the product where they have the highest absolute advantage, and then the other country can also. So given that, for example, the United States has got an absolute advantage on both commodities, it basically has to look at where it has the highest absolute advantage, and then the UK will have to look at where it has got an absolute disadvantage, but where that absolute disadvantage is going to be smallest, right? That's basically what they're going to be looking at there. But how do you do that? So there are basically two calculations, but our module, as I discovered last semester, seems to be in favor of the one, I think the one that we started off on second level, where you are going to be assessing the opportunity cost there. So if you look at in the United States, for instance, where the wheat is six bushels, and then clothing you have 4 yards there, you can basically come up with the autarky prices for that there. So of which 1 yard of cloth is going to be equal to, or the price of 1 yard of cloth in terms of wheat is going to be the same as 1.5. So when you divide 6 by 4, they should give you 1.5. So which means the autarky prices is going to be 1 C or 1 clothing is to 1.5. So it's going to cost you 1.5 of wheat to make 1 clothing. But then when you come to the UK, there 1 yard of cloth is going to cost you how much? That's 0.5. So basically it means that it's cheaper for you to do your clothing in the UK, right? Because it's costing them a lot less there. And then, which means that in the United States, it's going to be cheaper for you to be doing wheat. So one thing that you must understand with comparative advantage, they are always opposing. You can't have a comparative advantage on both products, right? Or both commodities. So in other words, once you can establish that the UK, once you can establish that it costs you a lot less to make clothing in the UK, then you can conclude, therefore, that the UK has a comparative advantage in the production of clothing. Therefore, it should mean that the United States has got a comparative advantage in the production of wheat. So the calculation can still be done from the perspective of wheat, looking at the price of wheat in terms of clothing. So under the US, you see that it's going to cost you also 0 point something, but in the UK, it's going to cost you a lot more, which is 2. Right? So you can basically come up with the same conclusion on there. So pretty much every exam is going to have this, right? So on our next session, what we're going to be dealing with, we are going to be dealing with the gains of trade. But before we deal with the gains of trade, I'm going to come up with previous exam questions where we are assessing comparative advantage and absolute advantage, where we have to identify that and decide whether trade is possible in terms of comparative advantage or in terms of absolute advantage there. And then from there, we're going to build it on to look at the gains of trade. So that's what we are going to be up to from next week.